Throughout history, whenever silver quietly became scarce, the same sequence of events followed. Not immediately, not with headlines or panic, but within 6 to 18 months, something fundamental always shifted in the global system. And right now, in December 2025, we're watching that exact pattern unfold again. Let me show you 3 times this happened, what came next each time, and why the evidence suggests we're entering the 4th cycle. Let's start with what most people don't understand about silver. It's the only commodity in human history that serves 2 completely different roles simultaneously. Gold is monetary. Copper is industrial. Silver is both. And that dual nature makes it the most sensitive early warning system for economic stress that exists. When silver becomes scarce, it's not because speculators are hoarding it. It's because 2 separate forces are pulling it in opposite directions at the same time. Industrial users need it to keep production lines running. And during periods of monetary instability, people want it as a store of value. When both of those demands surge together, silver doesn't just rise in price. It disappears. Now, before I show you the 3 historical examples, I need to establish one critical fact. Silver supply is fundamentally different from almost any other commodity. Oil can be extracted faster when prices rise. Wheat can be planted on more acres. Even gold production can scale up with higher prices, incentivizing new mine development. But silver is unique. Roughly 70% of all silver mined today comes as a byproduct of copper, lead, and zinc mining. That means silver production is not determined by silver prices. It's determined by the economics of base metal mining. When copper demand is strong, you get more silver as a side effect. When copper demand is weak, silver production falls, regardless of what silver itself is trading at. This creates a structural problem. When industrial and monetary demand for silver both spike simultaneously, there's no fast mechanism to increase supply. Mines can't be turned on overnight. Existing operations are already running at capacity. And because silver is a byproduct, you can't just open a new silver mine. You need a copper or zinc deposit that happens to contain silver. That takes years to find, develop, and bring online. This dynamic has repeated 3 times in modern history, and each time it preceded a major shift in the global economic or political order. Let's walk through them. The first example is 1939 to 1945. In the late 1930s, as Europe moved toward war, silver began quietly disappearing from global markets. It wasn't dramatic at first, but by 1939, the United States government was facing a problem. Industrial demand for silver was surging. Ammunition, electronics, bearings, silver was essential for wartime production. At the same time, countries around the world were losing confidence in paper currencies. Britain had gone off the gold standard in 1931. The dollar was devalued in 1933. Trust in fiat money was collapsing. So people were hoarding silver coins. They were melting them down. They were taking them out of circulation. By 1940, the U.S. Treasury was quietly leasing silver from its strategic reserves to industrial users because open market supplies were insufficient. And by 1942, the U.S. government banned the private ownership of silver in any form except jewelry and silverware. If you had silver bars, silver certificates, even large quantities of silver coins, you were required to turn them in. This wasn't about silver prices. Silver was still officially pegged at around 70 cents per ounce. This was about supply. The government needed every ounce it could get for the war effort. And when the war ended, when industrial demand moderated and monetary confidence returned, silver supply normalized. But for those 6 years, from 1939 to 1945, silver was effectively controlled by governments. The free market for silver ceased to exist. The second example is 1964 to 1971. By the early 1960s, another shortage was developing, and again, it was driven by dual demand. Industrially, the electronics boom was consuming massive amounts of silver. Televisions, radios, circuit boards, all required silver. Monetarily, inflation was rising. The U.S. was running deficits to fund the Vietnam War and the Great Society programs. The dollar was still theoretically backed by gold under the Bretton Woods system, but confidence was weakening, and silver coins were disappearing. In 1964, the U.S. Mint stopped putting silver in dimes and quarters. Why? Because the silver content of a quarter was worth more than 25 cents. People were hoarding them, melting them down, exporting them. The free market price of silver was rising above the face value of the coins. By 1965, the U.S. had effectively demonetized silver for everyday transactions. Coins became copper-nickel clad, but the shortage continued. Industrial demand kept rising. And by 1968, the U.S. government stopped redeeming silver certificates for physical metal. If you had a dollar bill that said payable in silver, too bad. The Treasury didn't have enough silver to honor those promises anymore. And then in 1971, the entire Bretton Woods system collapsed. President Nixon ended the gold window. The dollar became a pure fiat currency, backed by nothing except confidence. And silver, which had been trading at around 1.50 per ounce in the mid-1960s, began a decade-long bull market that would eventually take it to 50 by 1980. The shortage in the mid-1960s wasn't the cause of Bretton Woods collapsing, but it was a signal. It told you that the monetary system was under stress, that industrial demand was outpacing supply, and that something was going to break. The third example is 2008 to 2011. In the wake of the 2008 financial crisis, silver demand surged again. Central banks around the world launched quantitative easing, printing trillions of dollars, euros, yen. People lost faith in paper currencies and moved into hard assets. Gold went from 800 an ounce to over 1,900, and silver went from 9 to 48. But what most people don't remember is that there was a physical shortage. By early 2011, coin dealers were reporting delivery delays of 6 to 8 weeks. Premiums over spot price hit 15, sometimes 20. You couldn't just buy silver at the spot price. You had to pay a massive premium and wait weeks for delivery. Why? Because industrial demand was also spiking. Solar panels were starting to consume significant amounts of silver. Electronics were recovering post-recession. And the mints, the U.S. Mint, the Royal Canadian Mint, couldn't keep up. They were running 24-hour shifts and still had backlogs. This wasn't a speculative bubble. This was a physical shortage. And when silver peaked at 48.70 in April 2011, it wasn't because of some coordinated short attack, although that happened later. It was because the Federal Reserve and other central banks stepped in. They raised margin requirements on futures contracts, making it more expensive to speculate. They signaled that QE would eventually end, which it did, temporarily. And investment demand cooled. Industrial demand moderated as global growth slowed. And silver corrected back into the 20s and 30s for most of the next decade. But again, the shortage came first. The price spike came second. And the policy response came third. Now, let's talk about 2025. Because we're seeing the exact same pattern again, but this time the scale is larger and the dynamics are more urgent. Let's start with industrial demand. In 2025, global silver consumption hit a record. Solar panels alone consumed over 300 million ounces. That's more than 1/3 of total annual mine production. Electric vehicles added another 80 million ounces. Electronics, another 250 million. Add it all up, and industrial demand is consuming roughly 650 to 700 million ounces per year. Meanwhile, total mine production is around 850 million ounces. That leaves only 150 million ounces for investment demand, jewelry, silverware, and inventory rebuilding. Except investment demand in 2025 was not 150 million ounces. It was over 200 million. ETFs saw inflows. Coin sales hit records. Retail buyers were stacking silver bars and rounds. So where did the extra silver come from? It came from inventories. Vaults were drained. Exchange stocks dropped. Dealer inventories fell. The market balanced, but only by drawing down above-ground supplies that had been accumulated over decades. And here's the critical part. That silver is not coming back. When you buy a silver bar and put it in a safe, that silver can re-enter the market if you sell it. When a solar panel manufacturer uses silver paste on a photovoltaic cell, that silver is gone. It's embedded in a panel that's bolted to a rooftop and won't be recycled for 25 years. It's consumed, not stored, consumed. And that creates a fundamentally different supply dynamic than we had in 1980 or even 2011. In those previous cycles, when prices spiked, investment holders sold. The silver came back onto the market. Supply increased. Prices corrected. But in 2025, the majority of silver demand is industrial, and it's not coming back. Which means the structural deficit is not temporary. It's permanent until either supply increases dramatically, which takes years, or prices rise high enough to ration demand, which means bankrupting industries. Now, let's talk about the monetary side, because this is where the pattern gets even more concerning. In 2025, we're not in a normal economic environment. We're in the late stage of the longest debt expansion in human history. U.S. government debt is over $35 trillion. Deficits are running at $2 trillion per year. The Federal Reserve's balance sheet is still bloated from years of quantitative easing. Real interest rates, after adjusting for inflation, are barely positive. And globally, trust in fiat currencies is eroding. We've seen this in the bond markets, in currency volatility, in capital flows into hard assets. And silver, like gold, is benefiting. People are buying silver not just for industrial exposure, but as a monetary hedge. They're worried about inflation. They're worried about currency debasement. They're worried that the system is fragile. And when you combine that monetary demand with surging industrial demand, you get a market that's structurally tight. Now, here's where it gets specific. China. China is the world's largest consumer of silver, accounting for roughly 25 to 30% of global demand. And in 2025, China did something that should have been headline news, but was barely covered in the Western press. On January 1st, 2026, just days from now, China is implementing export licensing requirements for silver. Any producer or exporter dealing with more than 80 tons of silver annually will need government approval to export. Why? Because China has recognized that silver is strategic. They need it for solar panels. They need it for electric vehicles. They need it for their domestic industries. And they've decided to prioritize domestic supply over exports. This is not speculation. This is official policy. The export controls were announced in July 2025. They take effect in 1 week. And when they do, the amount of silver available to the rest of the world shrinks. If Chinese-produced silver stays in China, where does Europe get its silver? Where does the US get its silver? From Mexico, from Peru, from Australia. But those countries are already producing at capacity. There's no spare supply. So prices outside of China will have to rise to attract whatever silver is available. And we're already seeing this. In December 2025, silver in Shanghai has been trading at premiums of 2 to 3.50 per ounce over New York prices. That shouldn't exist. For decades, arbitrage traders have made fortunes closing these gaps. Buy cheap in New York, ship the metal to Shanghai, sell at a premium. It's automatic. It's mechanical. Except it's not happening. The gap keeps widening. And the reason is simple. There's not enough silver in Western vaults to ship. COMEX inventories are declining. Lease rates, the cost to borrow physical silver, have spiked to nearly 40 annually. That's unprecedented. In a normal market, lease rates are near zero. At 40, that's desperation. That's short sellers scrambling to find metal to deliver. And when lease rates spike like that, it's a signal. The physical market is tight. Now, I want to be very clear about something. I'm not predicting that silver is going to 100 next week or that the system is going to collapse tomorrow. What I'm showing you is a pattern that has repeated 3 times in modern history. Each time silver became scarce, each time industrial and monetary demand collided, something fundamental shifted in the global system within 6 to 18 months. In the 1940s, it was World War II and the end of silver coinage. In the 1960s, it was the collapse of Bretton Woods and the move to fiat currency. In 2008 to 2011, it was quantitative easing and a decade of central bank intervention. And now, in 2025, we're watching the 4th cycle unfold. The industrial demand is higher than it's ever been. The monetary stress is as severe as any period since the 1970s. And the supply deficit is structural, not temporary. So what does this mean? It means silver is not just a commodity. It's a signal. It's telling you that the system is under stress, that the balance between physical supply and paper claims is breaking, that governments and industries are competing for a finite resource. And historically, when that happens, when silver becomes scarce in this specific way, something bigger always follows. It might be a currency reset. It might be a policy shift. It might be a revaluation of hard assets relative to paper. I don't know exactly what it will be this time, but I know the pattern. And the pattern says we're early in this cycle, not late. Now, here's what you need to understand about timing. Silver shortages don't resolve quickly. The 1940s shortage lasted 6 years. The 1960s shortage lasted 7 years. The 2008 to 2011 shortage lasted 3 years. These are not short-term dislocations. These are multi-year structural imbalances. And they don't resolve because supply magically increases. They resolve because something breaks. A war ends. A monetary system collapses. A central bank intervenes. Something external happens that resets the market. Until that happens, the shortage persists, and prices reflect the tightness. So, if you're watching this in late December 2025, if you're seeing silver at 68, 69, 70 per ounce, understand that this is not the top. This is not a speculative bubble that's about to pop. This is the early stage of a structural repricing. The physical market is pulling away from the paper market. Industrial buyers in China are paying premiums over Western prices because they cannot afford not to. Investment demand is rising as people recognize that fiat currencies are fragile, and supply is constrained by the realities of mining and geopolitics. That combination, industrial plus monetary demand exceeding supply, has only happened 3 times before, and each time, it preceded a major shift. We're in the 4th cycle now, and the next 6 to 18 months are going to be critical. Now, let me address the obvious question. If this is all true, if the shortage is this real, why isn't silver already at 100 or 150? And the answer is inertia. The paper market, the futures market, the ETFs, they're still functioning. Most contracts are settled in cash, not physical delivery. The system hasn't broken yet, but it's cracking. Every week, more physical silver flows from west to east. Every week, industrial demand consumes another 15 to 20 million ounces that's not coming back. Every week, inventories drop a little more. At some point, the paper market will no longer be able to deliver if called upon. And when that happens, when confidence breaks, the repricing will be violent. Not gradual, violent. But until that moment, the market can limp along. Prices can drift higher slowly. Premiums can widen gradually. The disconnect between physical and paper can persist. That's what we're seeing now. The physical market is already pricing silver higher. Shanghai is at 71, 72, 73. But the paper market in New York is still at 68, 69. Eventually, one of two things happens. Either the paper market catches up, or the physical market decouples entirely. And if it decouples, if buyers stop trusting paper contracts and demand only physical metal, then the price is set by whatever the last willing seller charges. And in a shortage, that price is not 70. It's whatever it takes to make someone part with their metal. Now, I want to talk about what happened in the past when governments responded to silver shortages, because this is critical. In 1942, the U.S. government banned private ownership. In 1965, they stopped putting silver in coins. In 2011, they raised margin requirements to cool speculation. Governments do not sit by passively when strategic commodities become scarce. They intervene, and silver is increasingly viewed as strategic. It's essential for solar panels, for electric vehicles, for military electronics, for 5G infrastructure. Governments know this. And if the shortage intensifies, if prices spike too fast, if social unrest or geopolitical tensions rise, governments will act. They might impose export controls, like China just did. They might increase strategic stockpiling. They might even restrict private ownership in extreme cases, as the U.S. did in 1942. I'm not saying that's likely, but it's precedent, and it's something to be aware of. So, what should you take away from all of this? First, understand that silver shortages are not random. They follow a pattern. Industrial and monetary demand collide. Supply can't respond fast enough. The market tightens. Prices rise. And then something fundamental shifts in the global system. We've seen this 3 times, and we're watching it unfold again now. Second, recognize that this cycle is early, not late. The Shanghai premium just started widening in the past few weeks. Lease rates just spiked in December. China's export controls take effect in days. The industrial demand from solar and EVs is still ramping up. This is the beginning of the pattern, not the end. Third, understand that timing is uncertain, but direction is not. I don't know if the breaking point comes in 3 months or 18 months, but I know the direction. Tight physical markets, surging demand, constrained supply. That only resolves one way: higher prices. Fourth, be prepared for volatility. Silver is not a calm market. It spikes. It corrects. It gaps up, then pulls back. If you're holding physical silver, you're holding for the structural thesis, not for day-to-day price moves. If you're trading paper silver, understand the risks. Leverage cuts both ways. And finally, recognize that silver is telling you something about the broader system. It's not just a metal. It's a signal. When silver becomes scarce like this, when industrial and monetary forces pull it in opposite directions, when governments start implementing export controls and lease rates spike to 40, that's not noise. That's information. It's telling you that the system is under stress, that the balance between physical and paper, between supply and demand, between stability and fragility, is shifting. And historically, when silver sends that signal, something bigger follows. Not tomorrow, but within 6 to 18 months. So pay attention, not to the daily price moves, not to the hype or the panic, but to the pattern, because the pattern has repeated 3 times. And if history is any guide, we're entering the 4th cycle now. And the next phase is going to redefine what silver means in the global economy.